Our world is on the edge, teetering, as crisis looms not just over our favorite shops and bustling markets, but also across the vast oceans in the heart of Asia. We all thought China, freed from those super strict COVID rules, would come back big time, right? But things aren't looking so hot. People there aren't shopping much, their home sales are wobbly, and they're not selling a lot overseas because the US is like, we need to play it safe. And guess what's super loud? Young people without jobs and cities owing loads of money. Now, the world's feeling this pinch. Our stuff is getting pricier, and stock markets are like roller coasters. And here's the thing, China's big boss, President Xi, he's running out of magic tricks, and some are whispering, is China gonna be the next Japan? Now, 2023's got storm clouds brewing, and not the kind we like. There's this weird energy everywhere. Big shots are all twitchy and nervous. And it's not just because of faraway stories. We're feeling it too. Every time we fill up our cars or open our wallets, it hits us. Remember when our dollar was mighty and strong? Now, it's kind of wobbly. And prices? Through the roof. Then there's the big bank mess. Do you remember the good vibes when everything grew by 3%? Those were the days. Now, we're at just 1.1%, moving at a snail's pace. And jobs, they used to be our rock, but they're shaky now. Jobs aren't just numbers, they're our life. They keep everything rolling. There's a big storm coming. It's huge. Can we face it? Who knows? But one thing's clear, a big recession is knocking on our door. Now China was aiming for a 5% growth this year. And with the whole world only expecting to grow by a tiny 2.8% in 2023, China's 5% sounds pretty good, doesn't it? But here's where it gets wild. China was playing by these super strict COVID-0 rules back in 2022. That means their growth last year was super low. So, if we're really comparing apples to apples, their growth for 2023 is more like 3%. That's a big drop from the booming numbers they had before the pandemic. Bloomberg Economics pointed out that the first half of the 2023 China didn't grow by 5% as they hoped. That's a big red flag, signaling rough waters ahead for their economy. Now you might be thinking, why should we care? Here's the twist, when China sneezes, the whole world might catch a cold. Their economy is so big and so connected that if they hit a bump, we could all feel the jolt. That means, with China slowing down, other parts of the world, including us, might be heading for recession. It's like dominoes. When one falls, the rest could follow. So this week, China's big report card came out. Guess what? Their exports, down 3 months straight. And if that wasn't enough, they're buying less from other countries too, for 5 whole months. That's like forgetting to do your homework for half the school year. Prices over there are going down for everything, from the noodles they eat to those fancy city apartments. This might be the beginning of something called deflation. It's like when a store keeps having sales, but no one's buying. It's a big, flashing warning sign that businesses aren't doing so hot. The Country Garden, a huge real estate company in China. Imagine a big skyscraper building giant. They missed out on paying some serious money. They think they lost up to a whopping $7.6 billion in just the first half of the year. Now, if you're in China, all of this, it's like dark clouds rolling in. But for the rest of us around the world, it's also a big deal. Imagine this. Brazilian farmers looking at their soybeans, American ranchers at their cattle, and Italian designers at their handbags, all wondering, who's gonna buy all this? With China's economy slowing down, they want less of everything. Even the stuff that makes factories run, like oil and minerals. Any investor who hasn't been living under a rock is already aware that the primary economic risk factor in other parts of the globe, especially USA, is inflation. Prices over there have gone up 4% over the past year. And the Fed are fighting inflation like it's the final boss in a video game. Their secret weapon, high interest rates. Now, this is where things get tricky. High interest rates are like that double-edged sword. On one side, it makes borrowing money expensive. So companies thinking of growing big and bold might just hit the brakes. On the other side, it means people like you and me might think twice before splurging. That helps cool down those hot prices. So the Federal Reserve, not messing around, jacked up those interest rates from practically nothing to somewhere between 5% and 5.25%. And they might push it up even more next month. To make matters worse, the ongoing conflict between Russia and Ukraine has increased uncertainty, making forecasting the global economy impossible. This is particularly troubling for the retail industry. Initially, many believed the inflation surge was due to supply chain issues, but the narrative is changing. An increased consumer demand, likely driven by earlier pandemic-era stimulus packages and pent-up desires to spend, is now a predominant factor. And while most of you would think that our inflation problem stemmed mainly from tangled supply chains, imagine it as a massive traffic jam where goods couldn't move from factories to stores. But as days turned into months, a new plot line emerged. It wasn't just about those jams. No, it was also about us, the people with a burning desire to buy, fueled by memories of lockdown boredom and those sweet, sweet stimulus checks. Now, for any store owner, this might sound like a good problem to have. More customers, bring it on, they'd say. But here's where the plot thickens. With inflation, prices fall, well, everything, are on a rocket to the moon. It costs more for stores to get those trendy jeans, the latest gadgets, even the basic stuff. And with supply chains acting all wonky, getting goods is like solving a jigsaw puzzle with missing pieces. Retailers are stuck in this whirlwind, being pulled in every direction. Think of it as a pressure cooker situation. On one hand, the costs to run a shop are skyrocketing. On the other, there's a traffic jam-like situation. It's a weird mix of too much and too little. If retailers can't find a way to balance the scales, they could buckle under the weight. And if enough of them falter, it could send shockwaves through our economy, pushing us into that dreaded recession. So in essence, our favorite places to shop, usually bustling and bright, might just become the domino that starts a chain reaction we're all hoping to avoid. Now to sum up the whole discussion, the red flags on the horizon for 2023 cannot be ignored. The heartbeat of our cities, the stalls and markets that have defined our experiences, now face challenges unlike any before. As consumers, we are poised at a crossroads. On one hand, the allure of consumerism beckons, fueled by a history of unbridled spending. On the other, the looming shadows of inflation and economic downturn present a call for caution. The numbers from our beloved stores like Walmart, Target, and Nordstrom aren't just statistics. They're the heartbeat of a nation's economy. As the pulse wavers, one can't help but wonder if this retail crisis is the harbinger of a more profound economic challenge awaiting us. Whether it's tightening our belts or strategizing our next moves, one thing is clear: vigilance and adaptability will be our best allies in the uncertain times ahead. Stay informed, stay prepared, and most importantly, stay resilient. And as always, thank you for taking the time to watch this video. Remember to like, share, and comment below on your thoughts about the impending recession of 2023. Until next time, take care